In this video, we'll continue to learn about analyzing business transactions using the accounting equation. As we continue with the analysis of business transactions for Eli's Consulting, we're now looking at two new categories, revenue and expenses. Revenue or income is the inflow of money or other assets that results from the sales of goods or services or the use of money or services. When a sale occurs, the revenue increases assets, which is either cash for a cash sale or accounts receivable for an on-account sale, and increases owner's equity. An expense, on the other hand, typically involves the outflow of money for the use of other assets or the incurring of a liability. Expenses cause a decrease in owner's equity. Well, let's look at how we record revenue for Eli's Consulting. During the month of December, Eli's Consulting earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. The customers paid cash, which means that the cash account increased and revenue also increased. So let's write plus $36,000 for cash and plus $36,000 for revenue. In the seventh business transaction, we had revenue from cash customers. However, Eli's Consulting has some charge account clients as well. These clients are allowed 30 days to pay. Amounts owed by these clients are known as accounts receivable. This is a new form of asset for the firm. Claims for future collection from customers. During December, Eli's Consulting earned $11,000 of revenue from charge account clients. So in this case, for the eighth transaction, the accounts receivable increased by $11,000 and our revenue increased by $11,000 as well. In this next transaction, Eli's Consulting received $6,000 on account from clients who owed money for services previously billed. So in this case, the cash increases by $6,000 because the customer paid money to Eli's Consulting, but we aren't increasing revenue because we have already recorded the revenue. In this case, the accounts receivables decreased by $6,000. For the 10th transaction, we're going to record the salaries that Eli's Consulting paid for the accounting clerk and Sergio Sanchez. In this case, the cash decreased because Eli's Consulting issued payments to the employees, and we now have more salary expenses. So let's write that in the table, minus $8,000 in cash and plus $8,000 for expenses. For our 11th transaction, Eli's Consulting issued a check for $650 to pay the utility expenses. The cash decreased by $650 and expenses increased by $650. Let's now look at our last transaction. On December 30th, Eli withdrew $5,000 in cash for personal expenses. Withdrawals are funds taken from the business by the owner for personal use. Withdrawals are not a business expense, but a decrease in owner's equity. We decrease the cash by $5,000, and we also decrease capital by $5,000. We can now look at all of the 12 business transactions, and we can see that our equation still holds true. Assets equals liabilities plus owner's equity. Each side shows $136,850. My recommendation is to write down these business transactions in a notebook or in a document on your computer so you can refer to them. There are a limited number of transactions that occur all the time, over and over again, with some variations, of course, in terms of amounts and details. But the basic concepts are the same. So think of this as learning the vocabulary of a foreign language. There's no need to struggle with these basic transactions. Write these transactions down and refer back to them as you complete your homework problems. This is what your cheat sheet might look like, and you can continue adding more information to it as we learn about debits and credits. The next step after we finished analyzing our business transactions is to prepare a standard set of financial statements. Preparing financial statements is one of the accountant's most important jobs. Each day, millions of business decisions are made based on the information in financial statements, and countless of investors rely on the financial statements of publicly traded companies. Business managers and owners use the balance sheet and the income statement to control current operations and plan for future decisions and investments. Creditors, prospective investors, governmental agencies, and others are interested in the profits of the business and in the assets and equity structure. Let's look at the income statement. The income statement shows the results of business operations for a specific period of time, such as a month or a quarter. The income statement shows the revenue earned and the expenses of doing business. The income statement is sometimes called a profit and loss statement or a statement of income and expenses. So why do we prepare the income statement first? We'll need the net income to complete the statement of owner's equity. And we will need to know the owner's equity in order to complete the balance sheet. The income statement starts with the header section where we list the name of the business, the name of the financial statement, and the time period on the third line. In the body of the income statement, we list the expenses for the business and calculate the net income or profit by subtracting the expenses from the revenue. So now that we know the net income or profit of the business, we can prepare the statement of owner's equity. We start again with the header of the statement, which is the name of the business, the name of the financial statement, and the time period on the third line. The statement of owner's equity reports the changes that occurred in the owner's financial interest during the reporting period. So in the body of the statement, we start with the beginning capital balance of $100,000, which the owner contributed to the business in November. The income or profit belongs to the owner of the business, and we list that on the next line, but subtract any money the owner took out of the business. We list the increase in capital on the next line, and then add the beginning capital and the increase in capital to calculate the ending capital as of December 31st for a total of $133,350. Now we're ready to complete our financial statements with the preparation of the balance sheet. The balance sheet is a formal report of a business's financial condition as of a certain date. The balance reports the assets, the liabilities, and owner's equity of the business. In short, things the business owns, monies the business owes to vendors and to the owners of the business. This is a relatively simple set of financials. The financial statements of very large companies have much larger dollar amounts, but they follow the same concepts. Hope this was helpful.